You know what a black swan is? By definition, it's something that's been believed to be impossible or non-existent, but then later proven to be true. So in the case of the real black swans, it was the Europeans who found them in Australia back in the 1700s. They had always been there, but the people outside of Australia didn't know that. It's also something that has, as we refer to them today, something that has a major impact on most of our lives. So if you want to think about things like the COVID pandemic, if you want to think about things like the Russian invasion of a democratic country, the Ukraine, those are two of the more recent ones. Perhaps our speaker today could throw out a few more examples, but probably the biggest one going back is the bombing, the destruction of the World Trade Center. These are the types of things we refer to as black swans. So in this podcast, we're very privileged to have with us George Milling-Stanley. He is a leading authority on gold and why it's an important part of your overall investment strategy. George has traveled the far corners of the globe to meet with many people at many levels to determine the key drivers of gold and the direction of gold. Now, he started at the Financial Times of London, where he was a reporter, and went on to join the World Gold Council, where he was a director, and currently is with State Street Global Advisors in Boston, where he is the chief gold strategist and vice president. So I've known George for about 8 years, having managed a precious metals portfolio in my career, and every discussion brings new insights. So welcome to the potting shed, George. I'm wearing my black swan socks, and take it away.
Thank you, Marianne. It's a real pleasure to be with you. I have an intimate connection with black swans. I've actually been to Perth in Western Australia and seen the black swans sailing serenely along the Swan River between Perth and Fremantle. And I also had the pleasure of interviewing for a similar broadcast to this, in fact, a few months ago, interviewing Nassim Nicholas Taleb, who is the writer who actually coined the phrase black swans in reference to economic events. So intimate connection there with black swans. I think, that there is always a good reason to have gold in your portfolio, but there will also be times when a black swan event comes along and it would be a very, very good idea to up your allocation. But I think it's always a good idea to keep gold, if you like, in the DNA of the portfolio. So even if you're in one of those risk-on modes where equities are soaring, where the bond market's doing well, where all kinds of other assets are doing very well and gold is not doing very much, it can make sense from time to time to reduce your allocation, but I would advise people always to keep a little bit of gold in the portfolio. It's much easier to increase an allocation to gold than it is to introduce an allocation to gold when you're talking to investors. That's been my experience.
Okay, and just to go back to what people currently hold, I mean, we've talked about maybe 5% as a base number, but what is the average investor, institutional, retail? What type of holding do they currently carry in gold in their portfolios?
Very, very low indeed. If you look at the quantum of available investable assets around the world, then current estimates suggest that less than 1% is actually allocated to gold among all of that, which means I think that most people are way too low in terms of their allocation. It's still, for a lot of people, relatively new as an investable asset, I think that the introduction of gold ETFs back in 2004 in this country, I think that took a lot of the friction out of investing in gold. But nevertheless, for a lot of people, it's still a new idea. The literature basically suggests that in normal times, an allocation of somewhere between 2 and 10% would benefit any portfolio. And where a particular investor fits on that spectrum depends entirely on said investor's liquidity needs, tolerance for risk, and so forth. And that can depend to a large extent on the investor's age, for example. I think that at the age of 75, my tolerance for risk and my liquidity needs are very different from a 25-year-old investor. Let's put it that way. But somewhere between 2 and 10% is what the literature recommends.
So I'm sorry to interject a bit here, but if people hold on average about 1%, and everyone decides all of a sudden they need 5%, that's what you're talking about, that introductory trade, that could really drive the price up very quickly and throw disorder into the market and negate the benefit, perhaps, of being in gold if everyone's rushing in at the same time.
First of all, that's never going to happen, Marianne. I've been working in this field for 50 years, and I may have swayed 1 or 2 investors along the way, but I don't think we're ever going to see a gold rush of the kind that you're describing. The second thing is, it wouldn't necessarily be all that disruptive. The current amount of gold in above ground stocks, gold that has already been mined and turned into either bars for investment purposes or into products for jewelry or electronics and all the other different uses gold is put to, is somewhere around $13 trillion. So you'd need an awful lot of money flowing into gold to have any kind of disruptive impact on a market that big. What I was going to go on to say is that the literature that talks about any portfolio benefiting from an allocation between 2 and 10% also goes on to say that if you believe that you are actually already in or you are anticipating times of real turbulence in all financial markets, then it can make sense to double your allocation. So suddenly the conversation, given that I think we are in rather turbulent markets right now, with the banking crisis and so forth, I think that the conversation then becomes somewhere between 2 and 20%. And those are the kind of conversations I like to get involved in detail with an individual investor and find out about their particular needs, the reason why they want to invest in gold, why they want. Is it just as a hedge against inflation, or is it as a hedge against potential weakness in the equity market, or weakness in the dollar, or what other reason might there be? And there are myriad reasons, as you say. So I would want to drill down into what are the particular reasons that a particular investor has for wanting to invest in gold before we actually came up with a potential recommendation of a percentage figure.
Well, I'd like to point out to our listeners that I believe the best way to invest in gold is through the ETFs, the exchange traded funds. GLD is one of them. It's a SPDR, your company's gold ETF, and also the gold mini shares, the SPDR ETF ticker GLDM. So can you quickly describe the difference between those two?
Oh, sure, absolutely. We launched in conjunction with the World Gold Council. We launched GLD back in 2004 because there were a lot of investors. We talked to a lot of investors before we actually launched the ETF. And a lot of investors perceived significant barriers to investing in gold, to gaining the benefits that they knew gold could bring to a properly balanced portfolio, but they didn't have a way to do so. They didn't want to get involved in gold futures with the potential for putting up an initial margin and then the potential for requirement for providing additional margin in case the investment went down, whatever. There were a lot of different reasons. So GLD, as I say, was planned to try to take some of the friction out of investing in gold. And $60 billion later, I think it has been a real success. It very quickly garnered success among institutions, among hedge funds in particular, but also among some endowments and among some other investing institutions. And it has had widespread acceptance in the retail market as well. So GLD was sailing along serenely as a very, very deep and liquid investment. But 7 or 8 years ago, the higher ups at State Street became aware that there was a general trend across the whole universe of ETFs, not just gold ETFs, but across the whole universe of ETFs toward lower expense ratios. And I think this was in line with the regulator's focus on fiduciary responsibility, which was growing at that time and remains very, very sharp, that focus. And as a result of that, a number of people had launched tiny little gold ETFs with lower expense ratios than GLD. GLD comes in at 40 basis points per year of average daily net asset value. That seemed to us at the time of launching in 2004 a reasonable level of expense ratio, and we check in with our larger investors on a regular basis, and they tell us that they are perfectly happy with that. They see no reason for us to change. So with our existing investors being very happy with the way that GLD was structured and with the very, very deep liquidity that first mover advantage gave us in this market, we decided to launch a separate product in order to offer investors a product in the Spider family, in the State Street family. We launched GLD Mini, GLDM. That was launched in 2018 with an expense ratio of 10 basis points. Now, the difference between the two, it depends on why an investor wants to own his gold. I mentioned this point earlier, and it also applies with terrific relevance to the selection of the ETF vehicle that's chosen. GLD, because of its high liquidity, trading between $1.5 billion and $2 billion a day, has a spread between bid and ask on average of around about a penny. On a comparable basis, all of the other gold ETFs out there are at least 8 cents, and many of them as much as a dime or even more. So you have much lower entry and exit costs if you invest in GLD than if you invest in any of the others. If you're someone like myself who likes to rebalance to maintain a fixed percentage of gold in my strategic allocation in my portfolio, I like to rebalance once a quarter. So I'm trading on a fairly regular basis in order to do that. I also like to play with a tactical overlay, if you like, depending on how I feel about the gold market at any given time. So I will also be playing the market from a tactical point of view, as well as having an eternal strategic allocation, in my case of around about 5%. And I'll play with a tactical allocation anywhere from 0 to 15% on top of that 5% strategic allocation. So I'm a regular trader. GLD is obviously the vehicle for me. If I was somebody who would say, as some investors have said to me, look, I have $1 million, I want to put it into gold, I want to put it way over there and forget about it, and I just want to know that I always have access to movements in the gold price. I don't intend to rebalance, I don't want to maintain a fixed proportion, I just want to be a buy and hold investor, pure and simple. Then GLDM is the perfect vehicle for them. And we found a lot of people in the retail market felt that GLDM was the vehicle for them. They didn't want to have all the bother of actually going to the trouble of rebalancing or of trading a tactical position. So GLDM has worked for many, many different kinds of investors, while GLD maintains its position for all the investors that it already has.
Well, thank you for that. But can you also tell us how we know that the gold is there to back up these ETFs?
Well, I guess a lot depends on whether you trust the accounting profession. The gold in GLD is audited twice a year by an outfit called Inspectorate, which was an outgrowth of the former British Standards Office, which was privatized some years ago. But Inspectorate is an organization that has decades of experience at auditing valuable assets or valuable real assets, whether it's precious metals or whether it's art or whether it's fine wine or rugs or whatever it may be. And they have a very, very strong reputation in doing that. They do an audit twice a year of GLD's holdings. And then the sponsor of GLD is the World Gold Council, and their auditors do their own audit as well, entirely separate from what Inspectorate does. They do that once a year. Okay. And then the other thing I would say is, if you think about it, if you're in the precious metal custody business, as the two vaults where we keep GLD's gold and GLDM's gold both have long, long reputations in the precious metal custody business, basically, before you can close your books on a day's business, you have to know the location and the precise ownership of every single ounce of precious metals in your vault. So if you like, there is almost a daily audit carried out by the custodian himself.
Great, great. So, we talked about black swans and you mentioned volatility, but just can we just dig into gold as to why we want a position? What service does it perform, and under what conditions? What are some of the key drivers of the price movement?
Okay, good point. There's the drivers, as I said, are myriad. I've touched upon a couple of them. I think one of the main reasons that people in the United States like to have an allocation to gold is because they believe that it offers some protection against the ravages of inflation. And I think this is a fairly reasonable belief too. I can go into more detail about what gold actually does during periods of inflation, if you'd like, in a moment. But a protection against inflation is one thing. Gold has always offered some protection against potential weakness in the equity market. When equities go down, gold tends to go up. And that protection that gold offers has become much more important since the global financial crisis of 2008, because prior to that, a lot of investors used to look to the bond market to offer some protection against potential weakness in equities. But unfortunately, after 2008, stocks and bonds are relatively closely correlated. They tend to move pretty much in line with one another, which is unusual. So I think that gold has kind of assumed some of the role that fixed income markets used to offer in terms of offering protection against equity weakness. Then there's always the possibility of dollar weakness. There's a point of view that the main headwind for the gold price in 2022 was the extraordinary strength of the dollar, because the dollar was at a 20-year high against most other currencies. And I think that's probably a very good explanation for why gold didn't really do anything very much in 2022. Now, there is a body of opinion that believes that the dollar probably peaked in October of last year. In November, you may recall, the trade-weighted dollar index fell 4.3% in just 1 month, and that was the biggest monthly fall for over a decade. That may well have marked the peak of the dollar. We've seen the dollar tick up from time to time since then, but the general trend has been downward. It's not falling off a cliff, but the general trend has been downward, as other currencies, European currencies, emerging market currencies, and so on, tend to revert to the mean, and they have been moving up against the dollar. And I think that is likely to benefit gold as well, because in many respects, gold behaves very much like a component of the currency markets when currency markets are really moving rapidly. And I think that's the situation that we're in right now. I would expect other currencies and gold to appreciate against the dollar. So in other words, the gold price to continue to go up. So those are a few of the reasons. I think the other thing, the diversification benefits are absolutely incredible, in the sense that gold does not have a close statistical relationship with any of the other assets you'd expect to find in a typical properly balanced portfolio. Not with equities, not with fixed income, not with overseas equities, not with real estate, not with any of these other things. So gold tends to move to its own dynamic. And I think that offers some protection. A properly balanced portfolio for Harry Markowitz back in the day of modern portfolio theory in the 1950s was the holy grail of portfolio theory. And I think that gold offers benefits in the form of diversification. To kind of sum up, I would say that historically, the promise of gold for investors has always had a dual nature. One is that over time, and over time is the only way to measure the performance of any asset within a portfolio. Over time, gold can help to enhance the returns of a properly balanced portfolio. And over time, gold can help to reduce the volatility of a portfolio, to reduce the risk, if you like. Anything that enhances my risk-adjusted returns is an asset that I want in my portfolio. I think that's the main reason for my including it in my own personal portfolio.
Okay, so a lot of people just think about stocks and bonds in their portfolios, but as you referenced the Markowitz theory, when you add an alternative asset, and gold is, I think, the ultimate alternative asset class, then you can enhance your returns or you can reduce risk. it works in either direction, but it helps to have a much more balanced portfolio, particularly in volatile times.
Yep, absolutely. I think that we did a study a little while ago. We basically took a typical. Nobody has 60/40 portfolios anymore. So we took a typical global multi-asset portfolio with stocks of various different geographies and various different types, growth, value, and so forth. We took bonds, both government and corporate, again, domestic and overseas, high yield, and so on. We took some real estate, some private equity, and some general commodity exposure, a whole bunch of different assets like that. And we plugged in, given that the literature talks about between 2 and 10%, the basic literature on gold, we plugged in 2% gold, 5% gold, and 10% gold. And we projected this back to the time where, right after we launched GLD. And what we found was that the 2% level, mathematically, that doesn't make a huge difference to the performance of the whole portfolio. But that's the way we wanted to look at gold. What does gold do to the portfolio performance rather than how does gold perform specifically? So at the 2% level, we found a small increase in returns and a small reduction in risk. We figured that was pretty good. We found that those numbers were better at the 5% level. And given the portfolio that we chose, we found that the optimal level of allocation to gold, long-term strategic allocation is what I'm talking about, was at the 10% level. And I think that's very interesting. Now, that 10% level isn't going to be right for everybody. 5% is a level a lot of people were comfortable with. It's the level that Swiss and American banks recommended through the 1970s and 80s, for example. So, people will find their own level. But that's what the math showed us, was that for the portfolio that we chose, and we have to update this quarterly in order to meet compliance regulations at State Street. And that message has been very consistent that 10% was in fact the optimal level.
Very good. Very good. Good to know. I wanted to touch on the central banks because you have visited with many of them. You have advised them on their buy, sell, and hold decisions for gold. And for the average investor, how do we track their movements? Because they can definitely swing the price of gold.
Mm-hmm. Yeah, there have been some very, very interesting trends have emerged in central bank activity over the 50 odd years that I've been looking at gold. The way to track it, there are a couple of ways that you can do. The one is to gain access to International Financial Statistics, which is a monthly publication from the International Monetary Fund. And that will tell you what central banks report to the IMF. But I also like, given that not all central banks report and not all central banks keep their reporting up to date, and that some governments like to have, well, there's gold in our official reserves at the central bank, but we also have a state administration for foreign exchange, and we keep some gold there, and then we also have some gold in the treasury. So they have various different buckets that they might keep it in. And most central banks will only report on what they call their official reserves, what's in the hands of their central bank. So there is a second way of looking at this. The World Gold Council every quarter publishes a piece of research called Gold Demand Trends, which looks into trends in both supply and demand in the previous quarter. The next publication will be out this coming Friday, May 5th. And I think that that's always worth a look at. www.gold.org is their website. And one of the things they follow very closely is central bank activity. Now, obviously, a lot of their information comes from International Financial Statistics, the IMF publication I mentioned. But the researchers who produce the statistics for the World Gold Council do an enormous number of personal visits to central bankers, and they receive information. Sometimes the names are confidential, or sometimes they'll receive information that has not been made public, but that a central bank may be prepared to have it made public. Sometimes they're not allowed to reveal the names of the central bankers, but they have a lot of in-depth information which they gain themselves, apart from just what is published in the official record. That's probably the best way to keep an eye on things. It's very interesting. For the last 13 years, we have seen consistently, year after year, net central bank purchases, mostly from emerging markets. and mostly because these emerging markets believe that they are overweight dollar assets in their official reserves, and that with less than 5% allocated to gold, they are seriously underweight in gold. So they've been selling off some of their dollar assets and buying gold with the proceeds. And that's a trend that has been going for 13 years now. And all the central bankers I'm still in touch with tell me that that's a trend that's going to continue for the foreseeable future. And that trend got enhanced last year with a relatively new phenomenon, and this is something that certain commentators have described as the U.S. government weaponizing the international monetary system. And what they're talking about is that the US government managed to get Russia, not just the Russian government, but Russian corporations and even all the Russian population, booted from the SWIFT system of monetary transfers last year as a response to their invasion of Ukraine. And that gave a number of governments, and here you could mention perhaps North Korea, China, Iran, Saudi Arabia, many others, who felt that perhaps the US might at some point want to weaponize the monetary system against them. And what that did, I think, was increase the attractiveness of this asset that is universally acceptable and entirely anonymous in gold over the advantages of having the dollar. So that meant that net central bank purchases in 2022 were at an all-time record. Records go back to the early 1950s, and they've never been as high as they were last year. And I think that we probably won't match that all-time high in 2023, but we've already had a pretty good start as far as anecdotal evidence on the first quarter purchases is concerned. They've remained very, very strong, just about in line with those record purchases we saw last year. So I'm expecting that to be somewhere between 10 and 15% of total global gold demand in 2023, which is at least that level that they've been for the last 13 years. So there's a trend that is important to keep in mind. Doesn't necessarily push the price higher, but I think it provides a solid element of support whenever there's any downside tendencies in the price. So I'm not expecting much in the way of downside for gold from here, and there may well be some good upside to come.
Well, speaking of from here, it's May 1st and of 2023. And I'm wondering what your forecast is for the price of gold. It's a little over $2,000 per troy ounce today. Not quite the record, but would you give us the benefit of your knowledge in terms of that forecast through the end of the year?
Marianne, the team that I'm part of at State Street, the gold strategy team, is currently working. We've got a phone call tomorrow morning, in fact. We're currently working on figuring out what we will put into our mid-year outlook for the remainder of 2023, and probably with some hints as to what we might be expecting in 2024. We are currently above the base case scenario that we put together back in last December for 2023. So the price above $1,900, around $2,000, is a little above where we had expected it to be. And I think that we really need to up our ranges, and that's what we'll be talking about tomorrow. We won't come up with a figure for the year end. We won't come up with an average figure for the year, because I think that both of those are really rather a waste of time. What we try to do is to look at what economic and geopolitical circumstances are likely to obtain over the remainder of the period under review, and then to come up with a likely price range that the price might well trade in over the remainder of the year. And I'm guessing that the top of our base case may well be somewhere above $2,000. If what has happened in the first 5 months of the year are borne out over the remainder of the year, I think that we'll be upping our base case by a couple of $100. Our base case was originally $1,600 to $1,900. And I'm guessing that we'll be at the top of that will be somewhere above 2,000, because gold has already spent a good deal of time over 2,000. I think that we are likely to get stronger as the year goes on. But in about a month's time, we should be able to come out with our revised ranges for the remainder of the year. I'll make sure that you get a copy, Mary, and you can pass it on to your listeners as you choose.
Well, I need to thank you because we're running out of time here. But I also want to point out to our listeners that George has the largest gold ring I have ever seen in a museum or in everyday walking life. I believe it's 24 carats. It's very malleable because it's such high quality. It's so pure. And you've been wearing that wedding ring for how many years, George?
It will be 31 years this June. I was married in
31.
Yep.
Yep, right around the corner. That is probably the best financial decision you've ever made.
It's 1 ounce of 24 karat gold, and I have no intention of ever selling it. I do occasionally take it off to show to certain friends like yourself, but in general, it sits on this finger, and that's where it sits. And I'm very fond of it. It's one of my
Best
favorite things
wishes.
that I own.
Best wishes to the two of you. Thank you so much for your time and have a great day.
Marianne, thank you for inviting me to the potting shed. I look forward to coming back at some point, especially after we've got our mid-year forecast out. I'd be very happy to renew our discussion. A lot of things that we talked about in advance of this that we haven't been able to cover in our time. So I'd look forward to coming back soon. Be well. Thank you.
Thank you. Bye now.